This is the Nichols-Patrick Current Federal Tax Developments for the week of January the 26th, 2015. The current federal tax developments are brought to you by your State Society of CPAs and Nichols-Patrick CPA Incorporated. This audio podcast is intended for your own personal use, and any other use of this audio without the express written consent of your State Society of CPAs and Nichols-Patrick CPA Incorporated is prohibited. This podcast is copyright 2015 Nichols-Patrick CPA Incorporated. Let's go ahead and take a look at some of the developments that have occurred this week in the area of federal taxes. The first case we're going to look at this week is the case of Perez v. Commissioner 144 TC number 4. This case got some coverage outside the tax press, and in fact the tax court noticed that and mentioned it in their ruling because it covers a topic that's a little bit unusual. Ms. Perez was a donor of her eggs to infertile couples. She was paid a fee, $10,000, for each of the 2 times she went through this process. And what she was paid for, according to the agreement, because this is not just merely a, one day quick over, there's a whole set of procedures and very painful injections that are involved in preparing for being able to make the donation. And the court describes this in fairly decent detail in the opinion. The agreement that she signs with the organization that is compensating her for this makes it clear that they're paying her this $10,000 for her pain, suffering, going through the procedures, and complying with all of the things that have to be done. And she recognizes that she's going to have this painful process. In fact, as she signed back up for a second time, she was clearly aware the second time the nature of what she was agreeing to go through. Ms. Perez decided that, in fact, because she was being paid for pain and suffering, that this should be excludable under Section 104A2 of the Internal Revenue Code. Section 104A2 provides generally that a taxpayer may exclude from income amounts of any damages received whether by suit or agreement for personal injuries or physical sickness. Ms. Perez argued that clearly the agreement stated she was being paid for her suffering, and because of that, the $20,000 that she received for going through this process twice should be excludable. The tax court disagreed with her position. The tax court pointed out that there was that little word there, damages, and that in the regulations under this provision, the IRS made it fairly clear that you essentially had to have some sort of legal claim against somebody for something they had done in the past to meet the requirements of 104A2. In this case, the court pointed out, Ms. Perez was waiving her rights in the future to go after them for pain and suffering that she was fully aware she was going to go through. The court was concerned that if you opened up this Pandora's box and you allowed people to say part of my compensation was for pain and suffering that I expected to endure, that a whole lot of areas could be opened up. The court specifically mentioned that a professional boxer could very well claim that part of what he received was for pain and suffering. Various athletes could make the same claim because they reasonably expect to have pain and suffering. And even people in more mundane occupations outside professional athletes, where there's just a high level of danger or injuries occur over time, that risk is part of what they're being paid for. And the court said if we went back and said that we're going to exclude some or all of their compensation because part of what they're being paid for is taking on a riskier position, that would be going beyond what Congress wanted here in 104. Therefore, the court held that Ms. Perez was taxable on the $20,000 during the year in question. Next up is a case of Jacobs versus Commissioner. This is Tax Court Summary Opinion 2015-3. And this is the case, interestingly enough, the tax court ends up referring to this individual as a tax turtle. And that's important for this case. The concept the court was trying to get around when they said he was a tax turtle was that this taxpayer, who was a long-haul trucker, basically carried his tax home with him like a turtle carries its shell. And the problem with that is one can only get deductions, and he was asking for, part of what he was asking for, were per diem for meals. He had meals per diem while he was traveling as a long-haul trucker. The tax court ruled that because, in fact, this gentleman really had no permanent tax home. The closest he could get was arguing that a place in Minnesota where he would stay as a guest of a friend was his tax home, and the court found that didn't seem to work for him. That if you have no tax home, you cannot be away from your tax home, and if you're not away from your tax home, you can't qualify for the travel expenses under 162. So therefore, Mr. Jacobs, having no tax home, had no ability to claim a deduction for his travel expenses. Next up, something that many of your clients might think they want, but it turns out these individuals don't. Chief Counsel Memorandum 2014-04011 discovered that a whole class of business is exempt from the UNICAP regulations of Section 263A. Now, many of us might think that'd be great. Those of us who, though we all remember, right, the UNICAP regulations require us to go back out and capitalize many expenses beyond what we normally would capitalize if we are in the job of selling, manufacturing, reselling merchandise. We have to capitalize all kinds of expenses. It turns out, though, that might be a good thing if you're in a business where the only deduction you're allowed are deductions for cost of goods sold. Who's in such a business? Entities that are selling controlled substances illegally, at least federally illegally. Section 280 Cap E prevents them from getting any deductions for anything except for their cost of goods sold. Those individuals would be better off if they could capitalize all of these other expenses, throw them into inventory, and then at least finally get a deduction. The Chief Counsel Memorandum concludes that back when the UNICAP rules were passed, a provision was added in technical corrections that made it clear that UNICAP would not make anything deductible that was not already deductible. Therefore, the court rules, since 280 Cap E which was adopted prior to the UNICAP rules, prevented the deduction of these, what had previously been general administrative expenses, that in fact you could not add them to what you had and you could not add them to your cost of sales and be able to claim a current deduction. Now, the one piece of good news that came down with this, they also analyzed whether such an entity could be on the cash basis of accounting. And they decided that if it was generally on the cash basis of accounting, the service could force them back over to the accrual basis. However, it did conclude that they might qualify for the cash basis revenue procedures that allow taxpayers who meet certain criteria to automatically elect cash basis of accounting. If they do, then in that case, they would get a deduction as they paid for it for either the cost of production if they're growing the product. Of course, with legalized marijuana around the country, obviously there are people growing marijuana for commercial sale, and or if they are just in the business of selling the product, that they would also be able to, as they paid for product, be able to write that off at the time. Chief Counsel Advice 2015-04010 takes a look at something a little different than the last Chief Counsel Advice. It takes a look at whether a mortgage broker is in a real estate trader business. That's important because under 469C7, you may recall we get a real estate professional who can qualify, if they meet various criteria, to not have to automatically treat their rental properties as passive, potentially being able to write off losses that are incurred, or, under the current structure, may also exclude it from the calculation of net investment income for purposes of the tax under Section 1411, that 3.8% tax on net investment income. The tax, in this case, the National Office was looking at the question of could a mortgage broker be a real estate professional? Previously, the IRS had tried to argue real estate agents could not be real estate professionals because they weren't licensed as brokers at the state level. IRS did not fare well with that theory in court, and in fact, this memorandum glances quickly over that and simply states that real estate agents, even though they're not licensed as brokers, engage in brokerage business. But now the question is, what about mortgage brokerage? Does a mortgage broker render a real estate brokerage service? The memo concludes not. It concludes that the normal, regular definition of brokering a real estate sale does not include going out and getting mortgages. That's a financing option. That may be related to the sale, but it's not ultimately the key part of the sale. That wasn't brokering real estate, that's brokering mortgages or lending. In this case, the security just happens to be real estate. The memo points out that Congress at one point, when they're considering adding the real estate pro to the code, had specifically added financing activities as a real estate activities and then took that out. The memo concludes that, in fact, if Congress had meant to keep that in, they would have left it there, and if they meant them to be in the business, they would have left that in the code. The fact they took that out suggests strongly to them that they're not, and that Congress did not intend to include them. So despite the fact that a state might license them and even say it's real estate brokerage, mortgage brokerage, that's not relevant. Rather, mortgage brokering is not a real property trade or business, and it does not matter what the state calls it. In the case of Evans versus Commissioner, this case, Tax Court Memorandum Decision 2015-12, this deals with the foreign earned income exclusion. Generally, the foreign earned income exclusion, if you meet the bona fide residence or physical presence test, you're allowed to exclude a certain amount of earned income. But the problem is you have to be away from your tax home. That's fine. But the rule provides that, in essence, you have to have your tax home. You cannot have an abode in the United States. Section 911D says if the taxpayer has their abode in the U.S., they're not going to be allowed to claim a deduction for foreign earned income credit. In this case, this gentleman worked in a rather, shall we say, out-of-the-way location in Russia that was rather inhospitable. Weather can be kind of bad in Russia. It's definitely in certain parts of Russia, it can be very bad in the winter. He would work 30 days on, 30 days off. During his off periods, he would return to the United States and to where he had a home remaining in the U.S. and Louisiana. However, he attempted to claim the foreign earned income exclusion. The tax court notes that tax home is defined by where your work is, and in this case, his tax home clearly was now in Russia. That's fine. However, even though his 162 tax home was in Russia, for Section 911, the section that allows us to exclude foreign earned income, you have to show that you don't have an abode in the U.S. in order to count that as your tax home for foreign earned income exclusion. The court mentions that abode is a broader principle than is tax home. And in this case, the abode was decided that, in fact, because he essentially kept returning back to Louisiana, he actually spoke very little Russian. He depended on translators. Under the terms of his visa, he could not bring his family to Russia. And in fact, when he tried to get a visa for his daughter so she could accompany him, he was denied. It was felt that, in fact, what he had done was not really moved his living presence to Russia. He wasn't living there. Rather, his abode, which is sort of the idea of where you live, remained in the United States. So we have our level here is his tax home may have been in Russia for 162 purposes, but his tax home was not in Russia for purposes of the foreign earned income exclusion. They contrast this with a case that came earlier in this case, another case that we had here, where he said, well, I'm kind of like the result in the case of Jones versus Commissioner, but in Jones, the taxpayer worked for Japan Airlines. His family had lived with him in Japan. He was then assigned back to Anchorage, Alaska. After being in Alaska for a while, he was assigned back to Japan, and the family did not accompany him. However, as the court pointed out, he did not live in company-provided housing. He basically provided his own housing. In this case, Mr. Evans did live in company-provided housing. And he was not constantly returning to the U.S. He would only come back to the U.S. for vacations. But day to day, he was living and actually living in Japan, living as that was where he lived, essentially concurrently, with his time he worked. So because of that, they said his abode actually was not remaining in the U.S., despite his family did, and for that reason, he got the deduction. The court said this case for the oil worker was clearly different, and he could not qualify for it. A fact that may be of interest to you for next year, Revenue Procedure 2015-15, that is, returns you'll do for 15 in the early part of 16. The IRS has announced the average monthly bronze premium for 2015. This serves as a cap on somebody's amount they would have to pay as the shared responsibility payment if they don't have minimum essential coverage. That number for for next year will be $207 per person for 2015, I should say, up from $204. And the maximum you get no more than 5 people. If you have to cover 5 people, we keep multiplying each time we have to cover another person, but we stop adding them at 5. So that puts a cap for 2015 at 1,035, up from the 1,020 that we had as a cap before. In the case of Pitcher and Enders versus Waldman, we discover that, shall we say, as Neil Sedaka said, breaking up is hard to do. This was a very nasty breakup of an accounting firm. And it generates a tax issue, which is what's of interest to us. The individuals in question, Mr. Pitcher and Mr. Enders, were minority shareholders. Mr. Waldman owned a majority of the accounting firm. Mr. Pitcher and Mr. Enders decided they were leaving the firm. Mr. Waldman didn't like that subject. Litigation ensues. Eventually, they settle their claims, and Mr. Waldman Waldman ends up with the firm, but he essentially distributes out receivables to Pitcher and Enders, and he agrees and is paid directly from his insurance company for certain of the legal fees of Mr. Pitcher and Mr. Enders, because they were officers of the corporation. The corporation should have paid their legal fees, is the way that they agreed in the agreement. Mr. Waldman, though, after all of this was done, issued 1099s and revised W-2s to these individuals, which the court found had been, in fact, incorrect and had been issued primarily to get even at the other two. Mr. Waldman said, wait, I went now and I consulted an attorney who ruled and agreed with me that I had to file these forms. And the court said, you left out some key factors in the information you gave that attorney to consult, and because you are a tax professional, you knew those factors were key, and you left them out intentionally to get the answer you wanted, so you couldn't rely. However, the court did look at the general nastiness involving this breakup and decided that the harmed parties, shall we say, the other two, the minority shareholders, had been fairly responsible for what had gone on as well. So what he decided was the statute in question, in this case, Section 7434, imposes a minimum penalty of $5,000, or if greater, the amount of damages incurred, how much damages the people had incurred because of these false 1099s, as well as their legal fees. But the award of legal fees is discretionary. The district court had decided that because the other parties were responsible, and basically this legal process went on wildly for all kinds of things besides this 1099 miscellaneous, decided that in fact they were just as responsible as he were for the nastiness that led to this. So the court decided in its discretion it would not necessarily be fair to award legal fees and limit it to the $5,000. The Sixth Circuit Court of Appeals agreed with the district court that in fact the harmed partners were going to be limited to a $5,000 amount of damages. They could not qualify for the larger amount of damages because the court found that their legal fees were not properly part of what the damages should be. This has been the current federal tax developments for the week of January 23rd, 2015. You can go ahead and visit us online at currentfederaltaxdevelopments.com for more information and links to these cases, and you can join us next week for additional information regarding what has developed in the coming weeks as developments for federal taxes.